Why India just offloaded $50 billion, not during a crash, not during panic, but during calm conditions that most people believed were stable. The media called it routine, the markets called it diversification, but behind closed doors, this single move quietly changed how the global financial system should be understood. When one of the world's most conservative central banks exits without noise, it is never about profit. It is about survival. What followed did not appear in headlines or trend online, but it started a silent countdown that most investors will only notice when there is no exit left. By the time the bond market understands what this move really meant, the window to act will already be closed. Welcome to Financial Explanations. If you're someone who has lived through economic cycles, who understands that experience matters more than excitement, consider subscribing to this channel for clarity, not noise, and tell us in the comments from which country you are watching this unfold. The story did not begin with panic. There were no breaking news banners, no emergency press conferences, and no red screens flashing across trading desks. It began quietly, the way the most important economic shifts usually do. While global attention was fixed on political drama and short-term market movements, a decision was executed inside one of the most cautious financial institutions in the world. The Reserve Bank of India reduced its exposure to United States assets by nearly $50 billion. To many observers, this appeared ordinary. Central banks adjust portfolios regularly. Assets are shifted. Risk is managed. That explanation felt comfortable, and that was exactly why it was dangerous. India had always followed a careful financial path. It avoided sudden alignment, diversified slowly, and placed stability above speculation. Its reserve strategy was designed to survive long periods of stress, not to chase returns. This made India an unlikely actor for symbolic or impulsive decisions. When India moved, it usually meant that something fundamental had changed. Still, the public narrative minimized the decision. It was labeled routine diversification. It was described as normal reserve management. Most people moved on. But those who study long-term financial cycles understood that the size of the sail was not the real signal. The direction was. For decades, the global system rested on one belief. United States government debt was treated as the safest asset in the world. It was the foundation of reserves, collateral, and trust. Banks relied on it. Central banks anchored their balance sheets to it. Financial models assumed its stability without question. India had accepted this structure for years. That was why this shift mattered. The sale did not happen during recession or crisis. It did not follow a default or downgrade. It happened during relative calm when markets were functioning normally and confidence appeared intact. That timing raised an important question. Why leave early? Inside central banks, decisions are not driven by headlines. They are guided by long-term risk models that focus on sustainability rather than sentiment. These models do not ask whether an asset is popular. They ask whether it remains viable under stress. From that perspective, the concern was not volatility, it was solvency. Over time, United States debt issuance had accelerated. Deficits expanded during emergencies and failed to contract afterward. Interest costs rose steadily, taking a larger share of government revenue. What once seemed manageable became sensitive to small changes in rates. Rising yields looked attractive to short-term investors. To sovereign institutions, they signaled rising risk. When higher rates are required to maintain demand, the asset is no longer risk-free. India understood this difference. For a central bank, yield means little if long-term repayment confidence weakens. A higher return does not protect against currency erosion or fiscal imbalance. At that level, the risk is structural. This was where common analysis failed. Public discussion focused on market performance. India focused on arithmetic. The numbers showed growing imbalance between debt supply and global absorption. They showed increasing reliance on domestic buyers and monetary expansion. Stability was being supported by confidence rather than fundamentals. Confidence can disappear quickly. India's move was not political and not dramatic. It was a quiet acknowledgement that the risk profile of United States assets had changed enough to require adjustment. The amount did not need to be large to matter. In financial history, the most dangerous moments are not marked by crashes, but by early exits from institutions that rarely move first. Conservative players act before stress becomes visible. This was one of those moments. India did not abandon the system. It reduced dependence on its weakest assumption. That distinction was critical, because once a conservative institution recognizes structural risk, others begin reviewing their own exposure quietly, not publicly, not emotionally, methodically. This is how transitions begin, and the world was not in crisis, but it had crossed a threshold. And without noise or headlines, one of the most stable pillars of the global bond market had just been questioned. The consequences would not appear immediately, but they would not fade either. They would compound. The second layer of this story did not exist on television screens or social media feeds. It existed inside balance sheets, risk models, and long-term projections that most people never see. This was where the real decision was made. Central banks do not think like traders. They do not chase returns. They do not react to daily price movements. Their job is preservation. They protect purchasing power, system stability, and long-term trust. Every major decision they make is slow, deliberate, and usually invisible. That was why this move deserved attention. Inside a central bank, every asset is tested against extreme scenarios. Not optimistic ones, stress scenarios. What happens if inflation stays high longer than expected? What happens if interest costs rise faster than revenue? What happens if confidence weakens but issuance continues? These are not political questions, they are mathematical ones. For many years, U.S. government bonds passed these tests easily. Even when debt increased, global demand remained strong. Even when deficits widened, buyers appeared. The system relied on one key assumption. There would always be enough external demand to absorb new debt without destabilizing the currency. That assumption was no longer solid. As debt issuance accelerated, the pool of reliable long-term buyers did not grow at the same pace. Some buyers reduced exposure quietly, others shortened duration, some demanded higher yields. Each action alone looked harmless. Together, they changed the structure of the market. This created a subtle but critical shift. Higher interest rates were no longer a sign of strength. They became a symptom of strain. The government had to offer more to attract the same level of trust. For short-term investors, that was attractive. For sovereign institutions, it was a warning. Because when interest costs rise, they do not reset. They compound. Every new bond issued at a higher rate increases future obligations. Over time, servicing debt begins to compete with essential spending. When that happens, governments face only three options: reduce spending, raise taxes, or increase issuance again. None of these options are neutral. Central banks understand this cycle well. They have studied it across decades and across countries. The pattern is always similar. Early signals appear in the bond market. They are ignored because nothing breaks immediately. Then pressure builds slowly until confidence shifts all at once. India's models reflected this pattern. The issue was not whether the United States could pay its debt today. It was whether the trajectory made sense over the next 10 to 20 years without relying on constant confidence inflows. From a long-term perspective, the margin for error had narrowed. Another factor mattered just as much: currency exposure. When a central bank holds foreign assets, it is not just holding bonds. It is holding a promise tied to a currency. If that currency weakens over time, even full repayment delivers less real value. High yields do not protect against long-term currency erosion. This is where traditional analysis fails. Most commentators focus on nominal returns. Central banks focus on real preservation. They measure what those reserves will be worth when they are needed during crisis, not during calm. From that lens, concentration risk became impossible to ignore. For decades, the global system encouraged reserve concentration. One currency, one bond market, one anchor. It worked because trust was universal, but concentration is efficient only until it becomes fragile. India did not abandon that anchor. It reduced dependence on it. That distinction revealed strategy. The move suggested that India ISIS planners were preparing for a world where financial stress does not arrive as a single shock, but as a slow grind. In such a world, holding too much of any one asset becomes a vulnerability, not a strength. This was not about predicting collapse. It was about surviving instability. Another element reinforced this logic: buyer behavior. As foreign demand softened, domestic institutions absorbed more issuance. Central banks expanded balance sheets to stabilize markets. These actions prevented disruption, but they also changed the nature of the market. Prices became policy-supported rather than demand-driven. That shift matters. Markets supported by policy function well until confidence in policy weakens. At that point, stability becomes dependent on credibility rather than fundamentals. Central banks watch this transition closely because they know credibility is finite. India saw the transition already underway. From the outside, markets looked calm. From inside, the models, risk was rising. This explains the timing. Waiting for visible stress would have been reactive. Acting during calm allowed flexibility. Liquidity was available, prices were stable. Exit could be managed without disruption. That is how institutions reduce exposure without signaling panic. History shows this pattern repeatedly. Early movers are criticized. They are called cautious, overly conservative, or wrong. Then, later, their actions are reinterpreted as foresight. India was not seeking applause, it was seeking insulation. This part of the story reveals the deeper meaning of the decision. It was not about chasing alternatives. It was about acknowledging that the old structure demanded blind confidence, while the new environment required measured skepticism. The models did not predict disaster. They predicted imbalance. And in finance, imbalance is always resolved. The only uncertainty is how and who adjusts first. India chose to adjust quietly. In doing so, it exposed a reality the broader market had not yet priced in. The global financial system was becoming more sensitive, more leveraged, and more dependent on sustained belief. That belief still held. But it was no longer unquestioned. And once that threshold is crossed, the system never returns to its previous state. What transformed this decision from a national adjustment into a global signal was not the sale itself, but how other institutions interpreted it. In the modern financial system, sovereign actors rarely move in isolation. They observe, compare, and recalibrate, quietly and often without coordination. This is how shifts spread. When one conservative central bank alters its exposure, others do not copy the trade. They review their own assumptions. They rerun stress tests. They ask whether the same risks exist on their balance sheets. The process is slow, but the direction becomes shared. This is why sovereign behavior does not move markets immediately. It reshapes them gradually. For years, global finance operated under a single organizing principle. The dollar-based system was stable because everyone believed in it. That belief reduced friction. It simplified trade. It lowered borrowing costs. But it also created dependence. Dependence is efficient in good conditions. It is dangerous under strain. As more countries accumulated reserves, concentration risk grew. The same assets sat on balance sheets across continents. This was not a secret. It was accepted because the alternative appeared worse. Fragmentation seemed inefficient. Coordination seemed safer. That trade-off began to change. Countries with large reserves started asking a different question. Not, is this asset safe today? But what happens if everyone needs to adjust at the same time? In such scenarios, liquidity disappears, prices distort, and exits become impossible. India's move answered that question indirectly. By reducing exposure early, it demonstrated that diversification was still possible without disruption. That lesson mattered more than the dollar amount. It showed that repositioning could be done quietly, if done before stress appears. This is where the domino effect begins, not through panic selling, but through parallel reasoning. Other reserve-holding nations faced similar pressures: rising debt issuance, currency exposure, political uncertainty, expanding balance sheets. Each country had its own context, but the structural math looked increasingly familiar. Some shortened maturities, some adjusted currency weights, some increased non-dollar settlement. None announced these changes loudly. The result was not a collapse. It was a thinning. Demand did not disappear. It became conditional. Buyers required more compensation, more flexibility, and shorter commitments. This altered the shape of the bond market. Long-term certainty weakened even as short-term liquidity remained. This distinction is critical. Markets can function well with short-term demand. They cannot remain stable without long-term anchors. Sovereign buyers provide that anchor. When their participation becomes selective, the market becomes more sensitive to shocks. Another layer amplified this effect: coordination without coordination. There was no meeting, no agreement, no declaration. But similar incentives produce similar outcomes. Countries seeking autonomy naturally reduce overdependence. Countries managing long-term risk naturally avoid concentration. This is how blocs emerge without formal alignment. The BRICS nations, often discussed as a group, did not need shared ideology to move in similar directions. Shared exposure was enough, shared arithmetic was enough, shared vulnerability was enough. What followed was subtle but powerful. Trade began shifting toward bilateral settlement, currency swaps expanded quietly, reserve diversification increased incrementally. None of these changes disrupted markets individually. Together, they reduced the automatic recycling of dollars back into U.S. debt. This feedback loop had supported the system for decades. As it weakened, something else happened. Governments became more dependent on domestic buyers and monetary institutions. This did not cause immediate harm. Domestic absorption can support issuance. Central banks can stabilize yields. But these mechanisms transfer risk inward. Instead of being distributed globally, risk concentrates locally. That shift has consequences. When governments rely more on internal support, fiscal and monetary boundaries blur. Market discipline softens, policy choices become more constrained, and long-term planning becomes more sensitive to confidence rather than fundamentals. India's action highlighted this transition. It signaled that global risk sharing was no longer assumed. Each country would increasingly manage its own exposure rather than rely on system-wide stability. This is not fragmentation. It is self-preservation. From a historical perspective, this pattern is familiar. Major monetary transitions rarely begin with collapse. They begin with subtle adjustments by those who study history closely. They begin when participants realize that resilience matters more than optimization. The public often notices only the end of this process. By then, the options are fewer. This was why the move mattered beyond India. It was not about abandoning the system. It was about acknowledging that the system was changing faster than its narratives. The dollar remained dominant. The bond market remained liquid. The system remained functional. But beneath the surface, alignment was weakening. Trust was becoming selective. Participation was becoming conditional. Exposure was becoming strategic. This is how financial orders evolve, not with a single event, but with a series of quiet decisions that slowly reprice reality. India's decision was one of those decisions. It did not trigger a crisis. It revealed a direction. And once direction becomes visible, even to a few, the system can no longer pretend it is unchanged. The final implications of that shift were not immediate, but they were unavoidable, and they would not be felt by governments alone. The final layer of this story moved beyond governments and central banks. It reached the world of businesses, investors, and decision-makers who depended on stability without questioning its source. For them, the implications were quieter, but far more personal. When sovereign risk changes, it does not stay contained within policy circles. It flows outward into credit costs, capital availability, and planning assumptions. These changes arrive slowly, then all at once. By the time they are visible, the adjustment window has already narrowed. This was the danger. For decades, businesses operated in an environment where capital was abundant, interest rates were suppressed, and long-term planning assumed relative monetary continuity. Debt was cheap, refinancing was easy. Risk models relied on historical averages that no longer reflected structural reality. India's move challenged those assumptions. It suggested that the era of automatic stability was ending, not because of a crisis, but because the system supporting that stability was becoming less resilient. When long-term sovereign confidence weakens, capital becomes more selective. It demands higher compensation. It shortens duration. It favors flexibility over commitment. For businesses, this changes everything. Borrowing costs do not rise evenly. They rise unevenly, often without warning. Companies with strong balance sheets adapt. Those built on leverage struggle. The difference is not operational skill. It is timing and structure. This is why early signals matter. Most entrepreneurs and executives focus on demand, competition, and innovation. Fewer pay attention to the cost of capital that underpins all three. Yet when financial conditions tighten, even strong businesses face constraints they cannot control. Planning becomes harder. Expansion slows. Risk tolerance drops. This does not signal collapse. It signals repricing. Another shift occurs at the strategic level. Globalization was built on predictable finance. Capital flowed freely. Currency risk was manageable. Cross-border operations relied on stable settlement systems. When reserve structures shift, these assumptions weaken. Currency volatility increases. Hedging costs rise. Trade financing becomes more complex. Companies operating internationally feel this pressure first, but eventually it reaches domestic markets as well. Credit standards tighten. Liquidity becomes more valuable. Cash flow discipline replaces growth at all costs. India's action highlighted the return of these dynamics. It did not suggest panic. It suggested preparation. For decision makers, the message was not to predict disaster. It was to reassess exposure. Many strategies built during the last decade assumed that central banks would always intervene, markets would always recover, and debt could always be rolled forward. These assumptions were not guarantees. They were conditions. As those conditions change, strategies must change too. This is where most mistakes occur. Organizations wait for confirmation. They look for clear signals, a crash, a default, a policy announcement. But by the time confirmation arrives, flexibility is gone. The cost of adjustment multiplies. Early signals feel uncomfortable because they contradict visible calm. India adjusted during calm. That behavior offered a lesson. Resilience is built when it seems unnecessary, not when it becomes urgent. For entrepreneurs and business leaders, this means reevaluating fundamentals. How dependent is the business on cheap credit? How exposed is it to interest rate resets? How flexible is its cost structure if liquidity tightens? These are not pessimistic questions. They are strategic ones. The coming environment favors optionality. It rewards strong cash positions, diversified funding sources, and conservative assumptions. It penalizes over-optimization and fragile growth models. None of this requires fear. It requires awareness. India's decision did not declare a new order overnight. It marked a transition from unquestioned trust to conditional participation, from abundance to selectivity, from stability assumed to stability managed. This transition is slow, but it is directional. Those who understand direction early gain time. Those who ignore it lose margin for error. The global system is not breaking, it is rebalancing, and rebalancing always redistributes advantage. For serious decision makers, this story is not about India or the United States alone. It is about recognizing when foundational assumptions shift and adjusting before pressure forces the issue. That is the difference between reacting and preparing. India prepared. The rest of the world is still deciding whether to notice.